Good afternoon to all my very distinguished dignitaries for this webinar and all my participants who are there. And we are very happy to have you all. On behalf of Accounting Standard Body Board, it is my privilege to welcome you all for the second webinar in the new series, Leverage Leadership Legacy. Today's session addresses a subject of significant technical depth and continuing relevance in financial reporting, which is consolidation under Ind AS from control assessment to group reporting Ind AS 110 and 111. We are truly honored to have our past president CA K. Raghu ji for this session as a keynote speaker and CA Chinnaswamy Ganeshan ji as the eminent speaker and CA Maitri Swaminathan madam as the moderator of this very informative and relevant webinar. Now, I've been given the task to introduce our former president, C.K. Raghu sir. Sir is currently serving as the senior partner at K. Raghu and Company, a third-generation firm of chartered accountants based in Bengaluru. The firm is widely regarded for its excellence in audit, business advisory, taxation, and compliance consultancy. Sir has held the prestigious position of the president of India of Institute of Chartered Accountants of India, one of the largest professional accounting body in the world. Sir has held very distinguished positions in the past also. So with this, I just don't want to be in between hearing Sir on the very important topic of this webinar. Sir, can I request you to please take up the session now?
Yeah, thank you, Shalini, for having invited me to this session, webinar that is being conducted by the Accounting Standards Board. And thanks to my good friend, Chairman Sanjeev Singhal, who is not able to join us, for having invited me for this session to deliver the keynote address. In fact, Sanjeev Singhal has been doing excellent work as the chairman of the Accounting Standards Board. I remember the first time I met him a few decades back. He gave me a big book on accounting standards and told me, Mr. Raghu, I've authored this book, please go through it. And that is when I met Sanjeev Singhal. He was not in the council, but as the chairman of the Accounting Standards Board, he's doing an excellent job. My compliments to him. I'm also happy that we have amongst us CA Maitri Swaminathan from New Delhi. She'll be moderating the session. And Chinnaswamy Ganeshan, a good friend of mine, know him for more than 25 years. From Chennai, Chinnaswamy Ganeshan has contributed a lot to the profession, spoken at various branches across the country, overseas chapters, and his contribution to the development or maybe popularization of accounting standards is immense. And I've seen him committed to this cause, and I'm very happy that Chinnaswamy is handling this session this afternoon. Friends, the theme for this webinar, Leverage Leadership Legacy, which aims at promoting deep understanding of the accounting standards, also helps you to understand what the global perspectives, helps you to get better conceptual clarity on the subject. And basically, the aim of this particular webinar is to see how best, as a profession, we can enhance financial reporting. I think the Institute of Chartered Accountants of India has done excellent work over the last maybe more than 75 years in standard setting. And as a apex accounting regulator in India, all of us have witnessed the evolution of accounting standards. I remember when I did my CA in the year 1990, when I qualified, we just had 9 accounting standards, AS1 to AS9. AS9 used to be revenue recognition, and that particular standard was just announced 3 months before the examination, and everyone said there's a very likely chance of a question coming from AS9, and all of us had to put a lot of efforts to prepare for AS9. Luckily, we had a question on AS9. I was able to do well in that particular paper. So if you see the evolution of accounting standards in India, the Institute of Chartered Accountants of India has played a key role in developing the standards. We have a robust standard setting procedure, which is globally aligned with, and the kind of robust procedure which we talk about in India is something we need to be happy about it. We have the participation of the regulators like the Ministry of Corporate Affairs, RBI, SEBI, And then, in addition to that, we also have subject experts from across the country contributing to this. And the accounting standard board sets up a specific group. Let us say a particular standard has to be developed. So what we do is the accounting standards board constitutes a expert group to review a particular standard. It could be an international standard, or it could be a standard being developed by ASB. And once this expert group goes into the standard, it develops the standards. And once it is developed, it is put up for exposure, public exposure. After we get the public exposure, then it goes to the council. Council has a look at the standard and then gives its views. Then again, it goes to different regulators. And finally, once we get the feedback from all the regulators, the standard setting process moves forward, where we again it goes to the accounting standard board. Accounting standard board accepts it. Then it goes to the council. Council accepts it. Then it goes to public exposure. Once we get comments from the public and the regulators, then we notify the standard. And I think a very robust standard setting process. And currently, like there is a change with what was happening till now and what is happening now. Uh, for all corporate entities, even though the formulation of standards is done by the institute, these standards have to be recommended to NAFRA, and once NAFRA reviews the standards, it is notified by the Ministry of Corporate Affairs. Earlier, we had NACAS. When I was the president of the CA Institute 2014, the Accounting Standards Board used to, present the drafts of the standards to NACAS, National Accounting Standards and Accounting Committee on Accounting Standards, and then it used to be notified by MCA. Now, instead of NACAS, we have the National Financial Reporting Authority. For non-corporate entities, ICAI continues to issue the standards which have been widely accepted by the profession at large. And in fact, 2007, when I entered the council, one of the biggest agenda for the council was the convergence of Indian accounting standards to IFRS. The entire world was switching over to IFRS. We had, many countries that, just give me a minute, please. Yeah, sorry. So many countries, switched over to IFRS overnight. Like countries like Pakistan, I still remember when the IFRS convergence was happening around the world. They just one fine day, the Institute of Chartered of Pakistan said that we are converging to, they're adopting IFRS. So some countries adopted IFRS, some countries adopted the convergence route. So there's a debate in the council whether we should go for convergence or whether we should go for adoption. Very clearly, the view of the accounting standard board was accepted. The accounting standard board has recommended to the council that we should go for convergence because India is a large country, and as a result of which there might be a reason for us to not to go for adapting it, because by adapting it we may have a lot of issues, and then we decide to go for convergence. So then we had the convergence roadmap as to how the Indian accounting standard should converge with the globally accepted IFRS. And today I'm very happy to say that INDS is completely converged with IFRS, except for maybe a very minimal number of carve outs, maybe 4 to 5 carve outs. Other than that, I think we are completely converged with IFRS. That's something we should all be proud about. The Institute of Chartered Accountants of India, and especially the Accounting Standards Board, has played a very important role in this convergence process. And I'm very fortunate to have been a part of this convergence process. I was a part of the Accounting Standards Board. I was a part of the council to see how the entire process of convergence happened. And today, if you're looking at convergence around the world, more than 169 jurisdictions around the world have implemented IFRS, which almost constitute 98% of the world GDP. And out of 49,000 listed companies around the world, on 93 major stock exchanges, 29,000 companies, listed companies, use IFRS today in the preparation of financial statements. So that is something humongous and huge. So the entire world is now looking at IFRS as the most preferred reporting standard. And the ICI through the Accounting Standard Board has come out with educational materials on all the INDS, helping members to learn. And considering the fact that members find it difficult, e-learning modules have also been introduced for the benefit of members. Podcasts have been introduced. Executive development programs have been introduced. And more than anything, the INDA certification course. I think this is something very important for us to keep in mind, that the certification course on INDA is something very useful, relevant, and it gives you a deep understanding of all the accounting standards. So, in addition to that, the Accounting Standard Board is working with the regulators, with the MCA, SEBI, RBI, IRDA, and I'm sure with the participation of all the regulators in the standard setting process, nothing stops us from saying that yes, we are completely converged. Then, as far as the global contribution by our profession is concerned, I think the Institute of Chartered Accountants of India is represented on various international bodies. Had the opportunity of serving on the board of IFAC. Today, we are very actively working with the International Accounting Auditing Standards Board, Accounting Standards Board, and then we're also submitting our comments to IASB and IFRS Foundation on various consultation papers. We are active with the AOSS, GEG, and IFAS. All these are global standard setting organizations, and we have been playing a very important role. So, coming to what we as Indian Chartered Accountants should do, I have been given to understand that more than 400 CAs are participating in this webinar. All of you would be keen to know as to what exactly is expected from us, what is the way forward. And having traveled around the world, having seen how chartered accountants with expert knowledge in IFRS are in great demand, I personally believe that if you are specializing in in DS or IFRS, I think the plenty of global opportunities for all of you, whether it's US, whether it's Australia, whether it's UK. Chartered accountant with specialized knowledge of IFRS are in great demand. We should understand as to why IFRS is accepted as a global reporting standards. Today, we find that many Indian companies are being listed on foreign stock exchange. I come from Bangalore. Take Bangalore as an example. Infosys is listed on the New York Stock Exchange. So most of the companies are listed on foreign stock exchanges, and many companies in India raise capital from global investors. We also find scenarios where Indian companies are merging with entities abroad, or other entities abroad are merging with Indian entities. So, as a result of which, it is absolutely essential for us to have the knowledge of the International Financial Reporting Standards, or INDS. So, it is essential that when more and more companies are tapping the global stock markets, when they are looking at raising capital from them, there's a need for us to understand how financial statements have to be reported, using IFRS. Coming to the convergence, I already say substantially we have converged, and I think this process would continue. The convergence process continue. The institute is actively working on trying to see how best our standards can be completely converged. The third thing which I would like to talk about is a career opportunity, especially for young CAs. Go to a country like Australia or America. Chartered accountants with Indian CAs with knowledge of IFRS are in great demand. In global consulting firm, there are plenty of opportunities. MNCs also, we find a lot of opportunities in India. So both domestic opportunities and global opportunities are there. In India, if you look at most of the MNCs want CAs with specialized knowledge of IFRS. And then we have the global capability centers today. We are talking about how CAs can play a very effective role with the entire finance function moving to India. Chartered accountant with the knowledge of IFRS will be able to help companies around the world in a high quality financial reporting. You have no choice but to have the knowledge of IFRS. And in addition to that, overseas assignments, chartered accountants today are able to travel and then give the consulting to companies around the world. Another reason why IFRS is gaining ground is that investors are looking at financial statements. Global investors. When I talk about investors around the world looking at financial statements that are credible, transparent, investor friendly financial statement. I think this is something which we need to keep in mind, and that is how our role becomes important. Also, when we talk about the role of CAs, we also should understand that CAs are sitting in India are able to carry out global audits and assurance engagements, auditing subsidiaries of foreign companies, reviewing IFRS financial statements. So the international audit quality expectations are also increasing. So Indian CAs with the knowledge of IFRS can carry out global audit and assurance engagements. Coming to how technology is impacting the whole financial reporting today, financial reporting has undergone a huge change thanks to the digital transformation happening around the world. We have seen the digital transformation happening in India itself. You take the example of UPI, where you're able to buy products and services using your mobile phones. You're able to hail an auto, you're able to buy your groceries, vegetables, buy a laptop, air tickets, your tie, everything online. So you have a financial reporting system that can capture all these transactions happening online across the country. And the back end, you need to have a tech, what you can say, support that can convert or account all these transactions on an online real-time basis. Thanks to cloud accounting, thanks to new generation softwares, today what is happening, as and when a transaction happens anywhere in the country, accounting happens seamlessly. There's no need for anyone to punch any data into the accounting system. So thanks to AI based accounting softwares available, the ERP system state of the art that are aligned to the IFRS logic, we find that financial reporting is more or less automatic. Gone are the days where, when Chinnaswamy and myself were doing articleship, we used to see those traditional ledgers, daybook and ledgers. Then we saw the evolution of softwares in India, how accounting softwares became popular. And then we've seen last maybe 1 decade how cloud-based accounting softwares have become popular. And with AI based accounting software is becoming more and more popular. Entire ecosystem is changing. Accounting ecosystem is changing, and financial reporting has undergone a sea change. Where financial reporting used to happen 3 decades back, financial reporting that used to happen 2 decades back, and what it is happening today, you see a huge difference. And very one positive thing is that our profession has adapted to the change. And when blockchain would come way forward, again, we'll see a big shift in the way financial reporting would happen, and blockchain would impact the banking industry. Banking industry, the RBI is keen that blockchain should be adopted. Task forces are being set up in all the public sector banks. And what would happen is reporting would happen on an online real time basis. So, friends, what I'm trying to say is that technology has impacted financial reporting. And this is something which we need to keep in mind. We can't ignore technology. And the next thing which I would like to talk about is how we can provide advisory services. Not only in India, outside the country, we can provide guidance on revenue recognition, financial instruments, business combinations. These three standards are quite complicated. Chinnaswamy would agree with me. There's so much of interpretation that is possible. And many corporates look at chartered accountants with specialized knowledge who could guide them as to what should be the right accounting treatment, especially on revenue recognition, financial instrument, business combination. We can be strategic advisors. And finally, friends, what I would like to say is that there's a need for us to continuously update ourselves. Absolutely, there's no shortcut. All of us should keep updating our knowledge of what is happening around the world. Need keep ourselves updated on what is happening, in India, and see that we get aligned with the expectations of the regulators around the world. Sustainability reporting is gaining ground. Gone are the days where just financial reporting. Today, non-financial reporting also has become very critical. And digital reporting, XBRL came about 8 9 years back. Everyone thought how we could do XBRL. So XBRL has become so easy today, where all the items of the balance sheet and profit and loss accounts are tagged with XBRL tags. And then, very quickly you are able to, do your analysis on the financial statements using XBRL technology. So, friends, you need to understand technology, you need to understand financial reporting standards. And one way which I feel ICI is doing a great job, I wish to compliment the Accounting Standards Board, the chairman, Mr. Sanjeev Singhal, for the way in which they are, promoting global recognition of the Indian chartered accountants. They're encouraging continuing educational programs, encouraging chartered accountants to take up assignments overseas. I think they're doing a great job. So, with this, friends, I'm extremely happy to have been invited to deliver the keynote address. My good wishes to each one of you. I'm sure this program would be beneficial to each of you who are participating, and good luck to all of you. Thanks to the Accounting Standards Board for having invited me this afternoon. Happy learning.
Thank you, sir. Thank you for your nice words and very inspiring words, sir. As you rightly mentioned, technology is the key to the future accounting. Now, with this, I think our eminent speaker would be able to help us go through the this technical session, and that too with e-driven kind of speed. And for before inviting him, I would like to introduce CA Maitri Swaminathan, our moderator for this webinar. Ma'am is a brings over 3 decades of professional experience in financial reporting, governance, and advisory roles. She is a rank holder in chartered accountancy and company secretary, both the courses, and she has extensive experience advising organizations on sustainability, governance, and regulatory compliance. Ma'am, with this brief intro of yours, may I request you to please take up the webinar for further proceedings?
Thank you so much, Shalini. Thank you, and good afternoon to everyone, and welcome to today's webinar on Ind AS 110 and 111. We're pleased to be joined by Dr. Chinsami Ganeshan, as our past president Raghuji has already, shared some achievements of his and his contributions to accounting standards and popularizing them in the country. I'd like to, also share a further introduction of Dr. Ganeshan. So, Dr. Chinsami Ganeshan carries with him over 36 years of experience in the area primarily of auditing and auditing all sectors of our industry. He started his practice way back in
I'm joining. Sorry.
He began his practice way back in 1988, and he's worked with reputed firms such as Lovelock and Lewis, as well as BSR and Company, both of which are associated with the Big Four. He's presently the managing partner of Messrs. CG and Associates, Chartered Accountants, and he has to his credit over almost 1,500 papers at various seminars and workshops and conferences, whether in the country or overseas, and in various specialized subjects. And he's assisted numerous companies on Ind AS and IFRS transition. He's authored several books, and these books cover the subject of financial reporting and the Companies Act. He holds an honorary degree, doctorate in International Financial Reporting Standards, and he's been awarded a Lifetime Achievement Award in Finance from the Rotary International District. He's a recipient of the Jewel of India Award and a Certificate of Excellence for his various contributions. In addition to all this, he's also an independent director and chairman of the audit committee at Karur Vysya Bank, and also at Mrs. Bellstar Microfinance, which is a subsidiary of Muthoot Finance. He's been in the past also an independent director at the Railtel Corporation, which is a mini Ratna public sector. And apart from speaking for the various forums for the Institute of Chartered Accountants and supporting various boards of the institute, such as the IFRS Ind AS Implementation Committee, the Auditing and Assurance Standards Board, and various other committees of the Institute of Chartered Accountants, he's also associated with various other educational bodies such as IIMs, IIM Bangalore, IIM Lucknow, to name some. Shiv Nadar University. He speaks at the Institute of Directors and at various other forums. So it's a pleasure indeed to have you with us today, Dr. Chinsami Ganeshan. And without further ado, I'll not stand between you and the audience. I'll hand over to you for enlightening us all this afternoon about these two very important standards, one on consolidated financial statements and the other on joint arrangements. So with that, thank you for joining us. Thank you for sparing your time, and over to you.
Thank you, Maitri, for the kind words of introduction. And it's a privilege always to have the forum along with Mr. Raghu. During his chairmanship of Southern India Regional Council, I started having a lot of activities which has been delegated to me, and which has actually shaped my career also as a specialist on accounting standard, auditing standards, and of course on IFRS also. Thank you so much, sir. It's always a pleasure to see you at any point in time and interact with you. And my sincere thanks to the ASB chairman, again my good friend Sanjeev Singhal, as well as the other committee members, including Shalini, for making this to happen. And this topic which we are going to discuss is an interesting topic to see, because we know how to do a consolidation, but what we are actually looking at in this session, maybe for the next 1 hour or so, from control assessment to group reporting, Ind AS 110 and Ind AS 111. One is on consolidated financial statement of subsidiaries, and another is on consolidated financial statements of joint ventures, and joint operations is being given here. And what I believe is that let us just take a little bit of the standard and then look into the intricacies as well as the practical issues relating to the control assessment and how we decide that whether it's a subsidiary or it is a joint venture, how we go about it with the consolidation process. That is what I'm thinking of doing it here. So I think my screen must be visible. So I just wanted to take you through the various standards relating to consolidation to keep you very clear of how we are structuring the entire session as well as when to apply which standard correctly. So there are several standards which we have to consider. First, Ind AS 27, which is talking about how an entity will prepare a separate financial statements as per Indian accounting standards. And secondly, we are talking about Ind AS 28, where an entity has made investment in an associate or investment in a joint venture, how that investment should be reflected uh, for the purposes of recording in the separate financial statement as well as in the consolidated financial statement, where we are also talking about what we call it as an equity method of accounting for consolidation. And thirdly, we have Ind AS 110, which is talking about consolidated financial statement, even though we use the word consolidated financial statement for Ind AS 110. More specifically, this is a standard which talks about how a consolidation process will be done between a parent company and its subsidiary. So that is what 110. 111 talks about how we will do the consolidation of, say, for example, a joint venture in which an entity has invested, how the joint control has to be reflected in the consolidation process, as well as it's also talks about various other joint arrangements, like, for example, if two entities are owning a asset, sharing the benefits arising out of the asset, how the accounting should be done, whether it should be consolidated or it should be taken on a proportionate contribution which has been made for acquisition of the asset, and how the expenses has to be accounted for, how the revenue coming out of that should be accounted for. That is coming as per Ind AS 111. And of course, we also have one more standard relating to consolidation, which is Ind AS 112, which talks about the various disclosure requirement where one entity has investment in other entities. So when we look at the consolidation, we should look at all the 5 standards together so that we will be able to understand at one point in time, Ind AS 110 will apply, 111 will apply, or 28 will apply. Of course, the disclosures as per 112. 3 important concepts are crucial for any consolidated financial statement, and based on which we decide how the consolidation should be done. So let us look at the 3 concepts. These 3 concepts are uniformly used in many other standards as well. And accordingly, if we understood the concept or the definition of these 3 concepts, you will be able to do a lot of activities, not only on consolidation, but also on complying with the various Indian accounting standards as well. One is the control. That's a key theme of today's discussion. What is control? How the control is determined? Whether the control means a parent entity have a control over the subsidiary entity, or a parent entity have controls over many of its subsidiary entities, or the parent company has a control over a subsidiary and subsidiary has step down subsidiary, whether that step down subsidiary should also be considered as being controlled by the parent company. All these things are coming in. So for that purpose, we should first understand what we mean by control. In simple terms, if an entity can direct the financial and operating policies of another entity, we used to say there is a control existing. When we look at this control, we also look at normally, there's a presumptive assumption, uh, what we rebuttable assumption where we say that if any entity is having more than 50% of the voting rights of another entity, then the entity which holds the voting rights is controlling the other entity is what we normally look at. The difference between the definition of control as per accounting standards which we have seen, AS 21, is little different than the definition of control given as per Ind AS 110. The reason is, in respect of AS, we normally look at what is the voting rights. If it is 50% and upwards, we normally consider that it's a subsidiary and we start consolidating the financial statement. It is not like a rebuttable presumption. We normally go with the consolidation. Whereas in respect of Ind AS, it is not talking about just voting rights. It also talks about a lot of other matters to decide whether one entity has control over the other entity or not, which we will see a little bit. Control is the critical element for determining whether one entity has to consolidate the financial statement in which it has invested has to happen or not. The second concept, of course, I use the word significant influence here, and I have also used the second concept, but we are not going to deal extensively on this particular concept because we are going to talk about only 110 and 1111 and not our Ind AS 28. Significant influence, for your understanding, is that if an entity could participate in control, we are saying directing the financial and operating policies. Here, in significant influence, we are participating in the decision-making process that is on the financial and operating policies of another entity. We normally consider that the entity is having significant influence over the other entity. Again, the rebuttable presumption is if an entity holds 20% and above, but less than 51%, the entity is having significant influence on the other entity. Again, it's a rebuttable presumption. Under Ind AS, the concepts are considered differently with so many other factors, qualitative factors to be considered, just not only the voting rights. So that is enough for us for understanding significant influence. We will move on to the other topic which we are going to discuss, joint control. 111 deals with the concept of joint control. The moment you see the additional word added, joint control, you know that there is a difference between control and joint control. Joint control means two or more entities are having control over another entity. It is not a unilateral control. It is actually together there is a control being exercised, and that control may be on an enterprise, or it may be on an asset, or it may be on a resource, or it may be even taking some sort of facilities in which people are contributing. According to that, 111 defines the joint arrangement is in a different scenario, joint operations and joint ventures. Joint operations means we will not prepare any consolidated financial statement, which we will see a little later after we finish 110. We will look into that. And in respect of joint ventures, two entities are having a joint control over the other entity. In that case, they will consolidate their investment in the other entity using a method called equity method of accounting. So these two concepts, control and joint control, makes us to look into what exactly is the way in which we determine control or control assessment is being done under these two standards. Then only the next step of accounting comes in. I will say for Ind AS 110, first we will take up Ind AS 110. The entire control model given in 110 can be explained in a simple single slide. This is the crux of control assessment. what it says is that we must understand who is the investee, and on that investee, what is the power being exercised by the investor. So understanding the investee and on whom, what is the power we exercise should be assessed. This power should result in controlling the returns which may come out of that investment. For example, by means of dividend or by means of uh, synergies in operations, by means of interest or whatever you call. So, what type of returns will be coming and how I can control the variability of those returns through my power by means of my investment in the investee company is the next step. So the link is between the power and the variability of returns, which I can demand. How I will normally demand? By directing in the financial and operating policies of the investee entity. Actually, if you see AS21 is not having this analysis. It simply goes with if one entity is directing the financial and operating policy of another entity, that other entity is called the subsidiary and the entity controlling will be considered as a parent entity. This variability of returns, power analysis, linking the power and variability are not exactly in line with AS. But ultimately, because of this power and variability, I will be directing the financial and operating policies again. So in that case, if I could prove that there is a power and that power will be able to help me in directing the variability of returns, then the investee's financial statements has to be consolidated with the investor or the parent company. This is a one single line assessment which I should say. In fact, when we are talking about whether you have a power or not, how to analyze power, it says investor has to have existing right to give it current ability to direct activities. That's the reason why I said there is no big difference when we were talking about power analysis compared to our AS21. It is also talking about directing the activities, financial and operating activities, because that will result in how the investees' returns will come into the picture. So this is the entire gambit. The interesting factor is once you have assessed a control and you concluded that control is existing, that doesn't mean that is the end of the game. At every reporting period, you have to continually assess whether control is still existing or the control has been lost. Because the control has been lost means it is no more your subsidiary. And accordingly, consolidation will never happen because of the control assessment, which we have talked about, is no more existing. So in that case, what is the next or the correct accounting standard to be applied for the purposes of accounting for the investment in that particular entity is also a point of consideration. That is the reason why control position should be assessed on a continuous basis at each reporting period, whether there is an incremental control or there is a lapse of control or a loss of control. So let us look at the consolidated financial statement in a simple form. If I say one entity controls the other entity, automatically we are talking about consolidation. That is Ind AS 110. If we say there is a joint control, then we look at what is the type of the joint arrangement we have. 110 straight away says that you have to go for consolidation because control is existing. Whereas in case of joint control, we are looking at what type of arrangement you have with the other party. If both the parties are spent to buy an aircraft and the aircraft is being used by both the parties for a given period of time, which has been agreed in the joint agreement, joint control agreement. In that case, the asset, whatever I have contributed, say for example, A and B has contributed to the asset, whatever amount contributed by A will be recognized as property, plant, and equipment in its separate financial statement. There is no consolidation. And whatever B might have contributed for acquiring that aircraft will be accounted in its separate financial statement and not in consolidation. There is no consolidation comes in. Similarly, there could be a common facility which we might have created, out of which we draw certain assistance, or we use that facility. For example, in airlines industry, it's very common to see the ground activities, like taking the passenger from the terminal to the gate, boarding gate, and also the arrangements on checking in, etc. All facilities could be built by 2-3 airline companies joining together, and they will be spending for the expenses they incur, and they take the benefit out of that. In that case also, whatever contribution they are making, if it is revenue, they will charge it to revenue expenditure. If it is relating to capital, then it comes to arrangement of an asset being jointly owned. They will account proportionate of the amount which they have spent. Only when two entities have floated a separate entity, and the separate entity independently generates its own cash flows without dependent on the investor. The investment is the only thing, and then it generates its own independent cash flows. In that case, we will call that as a joint venture between entity A and entity B. So entity A will also do a consolidation, and entity B will also do a consolidation using the method called equity method of accounting, which we will see little later. Significant influence means, again, they will do that as an accounting for consolidation of associate investment as per Ind AS 28 using equity method. If there is no control, I made an investment in another entity, I don't have significant influence, I don't have joint control, I don't have control. In that case, that investment will simply be considered as a financial asset. The moment we understand these 4 concepts, you will know pretty clear when you should apply your mind or apply your accounting steps for consolidation under Ind AS. So let us move on. And what is when I use the word, it is not control being assessed just by means of voting right. I said it's a rebuttable presumption. 51% and more I have voting rights in another entity. Still, I can be considered as a non-controlling interest, whether the other entity which holds, say, for example, only 30% may be considered as the parent company, because it is controlling the entire entity. Let us look at how the control has to be assessed and what is the relevance of voting rights. See, this is what is guided by the standard. It considers into 2 parts. When voting rights are relevant, what are all the consideration you have to do to determine whether you have a control or not? Suppose voting rights is not important. You have lesser than 51%, but you have other rights. Whether that other rights gives you a control over the other entity is the next consideration which we have to look at. Let us see that little bit extra. For example, if the entity holds majority of the voting rights, 51% and above, we cannot simply conclude that this entity has control over the other entity. We have to look at what is the rights held by the other shareholders. I have taken some small examples in between, so we will look into that. Wherever it is not there, I will add up additional case studies orally to ensure that the timeline of the session is being maintained. So when I say the rights held by others has to be looked into, then only I have to determine what is the majority of voting rights. Here I can give a simple example. Say, for example, I have invested 70% in another entity. When I'm using the word I, it is not an individual. You assume that I'm a company. So I have invested 70% in another entity. but the 30% is coming from by the promoters of the company, and the promoters are holding a technical know-how. Only because of the technical know-how, I have actually invested in this. And when my investment has happened, we have entered into an agreement where the promoters with the 30% voting rights will be having the uh, majority of the composition of the board of directors, and they will be having the right to direct the operating and financial policies of the entity. In that case, even though I hold more than the majority of the voting rights, still I will be considered not as having a control over the entity, because by means of an agreement or by means of the technical know-how of the other party holding just to 30%, I acknowledge them as the person who can run the show or who can direct the financial and operating policy. In that case, the owners of 30% will be having controlling stake on the entity, and my investment will be only treated as a simple investment with a non-controlling interest. At the maximum, I can do consolidation as a associate entity, provided I was able to demonstrate significant influence. Or even with 70%, if I'm not able to demonstrate control, joint control, or significant influence, I have to simply account that as a financial asset or simple investment. Financial asset, why I am using that word is we have a separate standard or financial instruments which defines how the investments has to be accounted for. Let us take this second possibility is entity holds less than majority of the voting rights. Let us assume that I have made an investment of only 40%. 60% is held by some investors. In that case, what I should look at is there any agreement with the other voting holders? Let us assume that A Limited, B Limited, and C Limited jointly holds 100% of the voting rights in D Limited. A Limited holds only 40%. B Limited holds 20%. Maybe we'll consider it as 30%, and C Limited holds 30%, totally 100% on entity D. When we are looking at 40%, 30%, 30%, I don't have controlling stake. I only hold majority of the voting rights. So if something happens, see, for example, if I nominate my persons as the director in the board, they may get elected, and accordingly I will be having the possibility of directing the policies of the entity. However, if I look at the voting rights held by the other two groups, B Limited and C Limited, 30 plus 30, if they are joining together, they will hold 60%, and my nominees may get defeated, and accordingly I may not be having any control over the policies of that particular investee company. Let us assume that I have entered into, to avoid that particular situation, I wanted to have control. I entered into control with an agreement with B Limited, stating that I will manage this company, I will run the company, and whatever you are looking for as the returns, I will ensure that that guarantee is being given by means of my governance of this particular entity. So B enters into an agreement to vote always the same way in which A votes. In that case, 40 plus 30, 70% is a 70%. Any nomination made by that particular group will get elected, and controlling stake will be automatically comes in. So in this case, even though I hold only 40%, by means of agreement with the other vote holders, I got majority of the voting rights, and through that I could be able to demonstrate control over the investee company. So just less than majority of the voting rights is not eliminating the possibility of I exercise control. There could be any other contractual agreement, as I have given the example in the previous case. See, for example, I am the technology holder, and I say that you will be only a sleeping partner. and I will be having the nomination to the board. You will not have any nomination to the board. You may have a protective rights in case if I'm say doing something wrong. You may have the veto power to ensure that that resolution is not getting passed. Not all the resolution, only if it affects your own interest. If that type of arrangement, contractual agreement is entered into with the other parties, that is also taken into consideration. Another important factor is potential voting rights and de facto power. I have two slides, so I will defer the discussion to the subsequent discussion on these two items, because that is also important in determining, say today I may be having 40%, but tomorrow because of the potential voting rights, I may be able to exercise more than the majority of the shareholding. Whether that gives me the right to do that, that assessment is a separate assessment. We'll come to that by means of some case studies. And then we go into the next case where other than voting rights are relevant. See, for example, voting rights, I may be having say 40%, other person may be having 60%. But the decision-making process, because our interest is not to have the investment, but to run the company for some specific purposes. So for example, the entire manufacturing or entire products manufactured by the other entity will be completely bought by me. I will support them on all cash flow requirement, etc. In that particular scenario, even though voting rights is not there, we have to evaluate because of 100% buyback of the products manufactured, whether the investee company has any reliance on the operations of the parent company. So that is also another thing which is other than voting rights. Similarly, the evidence of practical ability to direct, that is a composition of the board of directors, etc., could also be possible. Right. Now, it uses the word consider only substantive rights. What do you mean by substantive rights? Here, I made a passing comment about protective rights. So if I have a right to protect my interest, that is not considered as a substantive rights, because that is restrictive or conditional rights. It can be exercised only if my interest is getting protected. Whereas if I see that on every operations of the entity or every decision-making process, I will be able to direct it, then it is called substantive rights. We have to only consider substantive rights arising out of voting rights, substantive rights arising out of other than voting rights if it is relevant. Okay, this is an important point, because no more shareholding is the basis to determine control. The other factors should also be looked into. Let me take one quick question. Here I'm saying B Limited and C Limited has incorporated BC Limited to construct and operate a toll bridge. Construction of toll bridge will take 3 years. B Limited is responsible for construction. The toll bridge will be operated by C Limited. Can it be concluded that during the construction phase that B Limited has all the authority to take decision, that B Limited controls BC Limited? If you remember the one single slide I have talked about, we are talking about control or power over the relevant activities. The power will be controlling the relevant activities at any point in time. When I say 3 years will be the total period required to construct and operate a toll bridge, and B Limited will come into the picture, C Limited will come into the picture only when the toll is ready for operation, but B Limited will be involved in completing or responsible for the construction. During that period, the relevant activities is construction or operating of the toll is the question which is coming in, based on which if we assess, we have to look at the assessment should be considered over a period of time. You remember that it is a continuous assessment which I'm doing it, and based on relevant facts and circumstances may change. And accordingly, in the present situation, B Limited will be controlling BC Limited during the construction phase. And when the toll operation starts, C Limited will be controlling the operations of BC Limited is what is to be concluded, because direct ability to direct the activities that most significantly affect those returns. So construction will most significantly affect the returns arising out of that, because investment will be going overrun or controlled savings could be achieved. All those things are within the control of B Limited during the control construction phase, and to that extent, B Limited is set to have control over BC Limited during the construction phase. Once the construction is over, they don't have any say because the operations will be done by C Limited, and the relevant activities which affects the returns is basically the toll collections and the related expenses which is incurred. At that point in time, C Limited will be considered as the parent company. B Limited will be considered as a non-controlling interest on BC Limited. So this is very, very important for us to understand how the control should be assessed. It is not just based on voting rights. The ability to control the the activities, and that will result in the returns. That is also very, very important. Power analysis and connection with the variability of the returns. Then we talk about another thing which I have passed in the previous situation, potential voting rights. So let us take this example, then we will understand. A Limited has 48% of voting rights in B Limited. The remaining voting rights are held by thousands of shareholders, not individually. Of course, this is not the example of potential voting rights. I think it's a copy paste issue. This is another case study. You remember that in the previous one, we have talked about even when we were talking about the entity holds less than the majority voting rights, we talked about de facto power, which I talked about de facto power. That is actually this particular case, not potential voting rights. 48% is the voting rights A held in B. The remaining voting rights are thousands of shareholders. None of them are having more than 1% of voting rights. Based on the past, they never joined together to make any collective decisions in the annual general meeting of the entity. In that case, whether A Limited have dominating voting interest to meet the power criteria. Let us look at that. 48% means rebuttable assumption it's only an associate because it's less than 51%. But at the same time, if I look at the rights held by the other shareholders, all are less than 1%. They never joined together. And accordingly, whatever decisions which I wanted to make by nominating my persons as in the board, all will get elected. Once they get elected, when the shareholders' decisions are being made, in that also, whatever resolution I wanted to move, by majority, I will be able to get the resolution done. In other words, the power to control the entire operation of the entity to make the variability of the returns in my favor will be with A Limited with just 48%. This is what we call it as a de facto power. Even though I have less than what we call the majority of the voting rights, but still I will be able to control the other entity. So that is what we will consider. A will be having control over the investee company. And let us look at sorry, I think that the slide on potential voting rights is not included. Let me just take the potential voting rights as our discussion point here. I thought that I will be having a slide on that. Let's look at this situation. I hold 45% of the voting rights. Another group is having 55% of the voting rights. But at the same time, the entity also issued some options, convertible options into equity shareholders. Let me assume that I hold 100% of the options given by the investee company. If that options are converted into shareholding, I will be able to add, say, for example, another 30%. So 45% plus 30%, 75%. Vis-a-vis, other person is having only 55%. 75 is to 55. Still, I will be having majority of the holding. So to that extent, with no voting rights at present, but I have potential voting rights, I can still be considered that because of my regular voting rights and the potential voting rights, I will be able to get this as a controlling stake. The only point which is being talked about potential voting rights is a simple point. This potential voting rights should be exercised at current period. That means if I decide to convert that into shares, I must be able to convert at any point in time. In that case, even if you have not considered or converted that into equity shares or voting rights, still I have to consider the existing voting rights as well as the potential voting rights together. The reason why I'm using the word is a currently exercisable potential voting rights is because the standard says if the potential voting rights can be converted into equity or voting rights after a particular point in time, or it requires an approval by the regulators, etc., which may take some point in time. If that period of time which may be taking, if it goes beyond the period end, then during that period end, this current rights of converting into equity shares is not existing for the options. And accordingly, I will ignore. That is the reason why currently exercisable potential voting right should also be considered to determine when I hold less than the majority of voting rights and then decide whether that will result in a majority voting rights. That is what potential voting rights is all about. And there is one point of importance we have to look at. This is actually coming from the Companies Act itself. Companies Act under Section 129, subsection 3, talks about exemptions from consolidation of financial statement. Say, for example, I have invested in entity B and B has invested in entity C. It is a chain holding. So A will be considered as a parent company or ultimate parent company. B will be considered as the intermediate parent company, and C will be considered as a subsidiary company. C will be subsidiary for B also. C will be subsidiary for A also through the holding of B's voting rights, right? In that case, whether B should also prepare a consolidated financial statement or only A can prepare a consolidated financial statement. Whether two exercise is required or one can be avoided. Companies Act has given this exemption, and that exemption has also been included as part of the accounting standard itself, Ind AS itself. Again, that standard, it is also available into the international standard. That's IFRS also, this exemption is available. Let's look at that. Whatever I have explained, I put it in different name. PQR Limited has invested in AB Limited, a wholly owned subsidiary of PQR Limited. It has also invested in BC Limited, another wholly owned subsidiary. And AB Limited has invested 60% in XYZ Limited, and balance 40% has invested by BC Limited. If you look at this particular structure, PQR has two subsidiaries and one step-down subsidiary. And in this case, I'm just taking an example of 100% holding for a simple understanding of the case law. See, in PQR Limited is 100% owning AB Limited and also BC Limited. And BC Limited and AB Limited together owns 100% of XYZ Limited. In other words, the investment or controlling stake is maintained indirectly by PQR Limited on XYZ Limited, because 60% is coming by means of my indirect investment in AB Limited and 40% comes through indirect investment through BC Limited, right? So XYZ Limited is also considered as a 100% owned subsidiary, but step down subsidiary. Now, if at all consolidated financial statement has to be prepared, what are all the entities has to be prepared consolidated financial statement? PQR Limited anyway has to prepare because it has two subsidiaries, one step down, subsidiary. Okay. AB Limited has one step down subsidiary because it holds 60%. So it should also consolidate the investment line by line of XYZ Limited with AB Limited standalone financial statement. BC Limited holds 40%, right? 40% means it's an associate. So it should recognize the transactions with XYZ Limited as under equity method as per Ind AS 28. Whereas if you really lift these two investments, who is the real owner? PQR Limited is the real owner. And how much is the investment? 100% of the investment. And accordingly, PQR Limited making a consolidation, BC Limited making, sorry, AB Limited making a consolidation, BC Limited making another consolidation. That consolidated financial statement of AB Limited and BC Limited getting consolidated with PQ Limited, too much of effort. So accordingly, what it says is that PQR Limited alone can prepare a consolidated financial statement. AB Limited and BC Limited being intermediate parent companies can avoid preparing a consolidated financial statement, provided there are certain conditions. What is required is that, again, there is another subsidiary, RST Limited, XYZ is having. So that is also another working. Whether XYZ Limited can avail the exemption from preparation and presentation of consolidated financial statement instead of doing RST Limited, still it is possible, because in the group, if the one person above the investment which I have made prepares a consolidated financial statement, all other people are considered as a intermediate parent companies. The intermediate parent companies are allowed to exempt it from preparation and presentation of consolidated financial statement, provided one entity above their holding should prepare consolidated financial statement. And again, that consolidated financial statement should be publicly available. This is the main condition. I must be a step down subsidiary. One person above my investment should prepare consolidated financial statement as a minimum. And that consolidated financial statement should be available publicly. In this case, what would be our best suggestion? We will say AB Limited, BC Limited, XYZ Limited don't prepare any consolidation. Let PQR Limited straight away making a consolidation of its investment in AB Limited, its indirect investment in XYZ Limited, and because of its indirect investment in RST Limited, and of course BC Limited investment also. That is the best way of doing this. In other words, in this case, PQR Limited will be the ultimate parent company. All the four companies will be considered as the subsidiaries of PQR Limited. In fact, for AB Limited, BC Limited is called a fellow subsidiary. Okay. So this is the framework where you can get a exemption from consolidation of the financial statement. And if all the three conditions which I have mentioned is satisfied, naturally XYZ Limited can take the exemption from consolidation. Coming to the accounting aspects of this entire discussion on consolidation, I normally wanted to break the standard into a step-by-step process. Reason is very simple. If you go even for a baby to start walking, it has to take baby steps, slowly getting the strength and then move on. Similarly, when we were trying to understand a complex standard on consolidation, if you are going and trying to understand that entire standard through reading the entire passage, either we may get bored, or most usual statement is when you read more and more, you will get confused. So accordingly, I believe that there are 6 critical steps involved in consolidation. And of course, maybe it will have a little bit of additional sub-steps, but main steps are 6 steps. Let us try to understand the 6 steps. One is consolidated financial statement should be prepared by the group for all its investment in subsidiaries, associates, and joint ventures. So now associate I'm not considering, both for the subsidiaries as well as joint venture, they have to prepare consolidated financial statement. For consolidation under Ind AS 110, we will add up all the assets, liabilities, income, expenses on a line by line consolidation. Whereas for joint venture, we will go for equity accounting. This is the entity which is going to prepare consolidation, and what are all the entities whose financial statements are going to be consolidated. This is the first to determine, and what is the basis of consolidation is the next one. However, the important aspect is, since we are preparing the consolidated financial statement, consolidating the standalone financial statement of the parent with that of the standalone financial statement of the investee companies, naturally, to make a meaningful financial statement at a consolidated level, the accounting policies adopted by the parent company and its subsidiaries should be uniform. Uniform accounting policies should be used, and based on which they have to consolidate. There could be a possibility the financial statements are not prepared on uniform accounting policy. Say, for example, ultimate parent company prepared with a different accounting policy on depreciation, whereas the one of the subsidiary is preparing or adopting depreciation with a different accounting policy, then making a comparable or meaningful addition of line by line item, that policy of the subsidiary should also be converted into policy of the parent company, uniform accounting policy. Normally, vice versa will not happen. The parent company's accounting policy will not be changed to adopt the subsidiaries policy. So subsidiaries accounting policies will be converted to comply with the accounting policy adopted by the parent. Let us assume that the subsidiary is an independent company which got an independent audit, they have get it audited, then how I will be able to do that change of the accounting policy? Normally, it will be possible to say right from the beginning when the subsidiary is formed, these are all the accounting policy to be done at the group level for group reporting purposes. So you follow this as the accounting policy. Very simple method. Suppose if for some reason it is not possible, then if I apply the uniform accounting policy, what would be the amount of recognition of an asset or liability, or what would be the consequential impact on my income or expenditure should be adjusted as a consolidation adjustment in the preparation of the consolidated financial statement. So that is the first step. Second step is we have to combine the financial statements of parent and subsidiaries. I have not used the word consolidated. I have conveniently used the word combining the financial statement to make it simple that in respect of parent and subsidiary relationship, all the items of assets and liabilities, income and expenditure are added together on a line by line basis. The same asset will be added with the parent company's asset and consolidated number will be given. For example, property, plant and equipment of parent company will be added. It will be along with that, all the property, plant and equipment values carrying amounts of all the subsidiaries will be added, and that becomes the consolidated property, plant and equipment's carrying value. So that is to make that understandable. For example, revenue from sale of products. Parent company sale of product, subsidiary 1, subsidiary 2, subsidiary 3, all put together will be the revenue from operations by sale of product. Sale of services, similar exercise. Employee cost, similar exercise. Depreciation and amortization, similar exercise. Finance cost, similar exercise. Taxation also, let us hold for some time. Whether it's a similar exercise or a different exercise, we will hold for some time. That is the reason why I use the word combining the financial statement of parent and subsidiaries on a line by line basis, like assets, like liabilities, like items of assets, liabilities, income and expenditure will be added together on a line by line basis, and that will be the amount to be reported in the consolidated financial statement. That's the second step. When I'm doing this analysis, there could be a possibility that in the parent company, the amount contributed towards the share capital of the subsidiary will be shown as an investment, right? Whereas in the subsidiary, that is not shown as an investment. It is actually not even as a liability, but shown as an equity in the standalone financial statement of the subsidiary. So accordingly, what was my investment if I am simply adding line by line? My equity plus the equity of the subsidiaries will also be added. And then my investment will be shown as an asset, which is actually wrong. Ind AS 1 also talks about netting off this, and this is nothing but inter-group transaction or balances. To that extent, it has to be get eliminated, right? So when I'm eliminating, the investment will get eliminated with the equity portion at the date of investment in the subsidiary. That's the third step. When I'm doing this, there could be a possibility of I'm holding 100% of the equity in the other entity in the subsidiary, or maybe some other persons will also, or some other investor has also invested. They are called non-controlling interest. What is the value of the non-controlling interest has to be determined in the net assets as well as net income, and that should be removed, or it should be presented separately in the P&L. What is attributable to the controlling shareholders, what is attributable to non-controlling shareholders in the consolidated profit and loss account, and in the liability side, because assets are consolidated line by line. In the liability side, I will also show what is the non-controlling interest as part of the equity. This is what is the fourth step. Non-controlling interest has to be determined. And there are two ways of determining non-controlling interest, whether you wanted to account for the entire goodwill or you wanted to do only a partial goodwill. Depending upon that, the non-controlling interest valuation is also coming in. We'll look into that a little differently. When I'm doing this exercise, there is a possibility that, in the third step, there could be a possibility of my investment will be higher than what is my portion of equity in the other entity. In that case, there could be a possibility of goodwill or reserves which may be coming in, capital reserves which may be coming in. We will look into that as a sub-process of process 3. The elimination of intergroup balances, intra-group transaction, and resultant unrealized profit or losses. There are 3 items we are talking about. Intra-group balances, like investment and equity. There could be a possibility that the parent company might have sold goods to the subsidiary company. In that case, parent company may be showing that as an trade receivable. Subsidiary company will be showing the amount payable as trade payable. So intra-group balances will be eliminated. The receivables and the payables will be knocked off and they will be eliminated. Similarly, I have sold goods to the subsidiary company, and subsidiary company recorded that as a purchases in its standalone financial statement. Again, the intra-group transactions are eliminated. Second thing is over. What is the third one? Resultant unrealized profits or losses. Let us assume that parent company sold goods to subsidiary company. Subsidiary company has not sold the entire goods purchased within the year end, and there are some inventory outstanding or inventory lying as on 31st March. That is a year end. In that case, how the inventory as per Ind AS 2 has to be valued, it should be cost or net realizable value, whichever is lower. In the books of the subsidiary, it is a cost because they have purchased it, it's a cost. But when it comes to consolidation, line by line, when I'm adding the inventory of the parent company is still in cost, but the inventory which I have sold and lying as an inventory in the subsidiary company is actually at my selling price. So the unrealized profit between my cost and my selling price has to be eliminated That is what step 5, third sub-process says. After intergroup balances are eliminated, transactions are eliminated, the unrealized profit and losses should also be eliminated. There is a sub-process called what would be the taxation impact arising out of that unrealized profit elimination. The reason is very simple. When I am removing the unrealized profit elimination, only for my presentation and disclosure, this is being done. For taxation purposes, the group still has the benefit of claiming what is my closing stock this year in the subsidiary as an opening stock of the next year for taxation purposes. That means whatever unrealized profit which I am eliminating, still I will get the taxation benefit in the next year. So the tax impact is actually deferred to the next year. The moment I use the word deferring the tax impact to the next period because of the temporary differences arising out of timing, then naturally I have to account for what we call it as a deferred tax asset in that particular situation, right? So Ind AS 12 will also come as part of the accounting. That is the reason why I said, please hold when you say line by line consolidation of assets and liabilities, whether your deferred tax asset and deferred tax liability will also be consolidated as a line by line item, subject to adjustment for any elimination of intercompany unrealized profits. That is what important. Then comes is what is your presentation and disclosure. And of course, the presentation is as per Schedule 3, Division 2. If it is a normal company, if it is an NBFC, then Schedule 3, Division 3 will be applied as a format of presentation. Disclosures as required by law, disclosures as required by the relevant accounting standard, including accounting policy, accounting estimate, judgments made, everything as applicable to a normal standalone financial statement will be given there also provided. Only additional point which we have to look at is what is relevant to consolidation has to be included therein. Okay. So I think there is a question which has come in the chat box. Question number 1 is, an entity holds 46% equity in another company. The remaining shareholder is widely dispersed. Historically, the entity has been able to pass all shareholders' resolution. From a practical standpoint, would this entity is required to consolidate investment, and what evidence would be critically to support de facto control? As you yourself has told, Rahul, I have already mentioned this in respect of my example itself, that it's a de facto control, and to that extent, you have the control over that, and you will consolidate the financial statement. So only thing which you have to look at is what is the way in which the other shareholders and what is the shareholders' resolutions are being passed in the previous periods will be helpful. The second question is, a majority investor has veto rights over changes to the business plan and major capital expenditure. In practice, how do we determine whether these rights are protective rights or substantive rights, and how would this be impact the control conclusion? Very relevant question. Again, if you look at what I have mentioned as a passing comment when I was talking about the control assessment, is that just because I have a veto power in the present case, which is coming in the example, they have only said that if there is a change in business plan or change in a shareholding pattern or a capital expenditure, at that point alone you require my concurrence. I have a veto power not to say okay. But in all other cases, you have the power to direct the financial and operating policies. In that case, this is considered not as a substantive rights, but it is considered as a protective rights. And to that extent, there will not be any consolidation which I will be doing. I will be just considered as an investment in the other entity. So that is the way in which we'll look into that. Okay, let's take another example for the accounting policies. Entity A prepares consolidated financial statement to 31st January each year And of course, this example may not be suitable for Indian scenario unless only one condition is satisfied. This is a subsidiary of a foreign company where consolidation requires, and they are adopting a different accounting period. That was very clearly explained. Otherwise, under the Companies Act, 31st March will be the year end. Let us assume that in this case, A Limited is a subsidiary of a foreign company. Foreign company closes its books on 31st January, and this company has also got an exemption by applying to MCA and got that exemption. So with that, we will proceed. Entity A prepares consolidated financial statement on 31st January. One of A's subsidiary Y prepares the statement on 31st December, but not on 31st January. On 30th January 2021, Entity Y suffered a major fire in one of its factories. This event was a non-adjusting post-balance sheet event in Y's financial statement. How you will treat that in consolidation? Because we said we have to use the significant accounting policies alone we have discussed. There is one more point which is coming in is uniform accounting period should also be used. But at the same time, the standard gives that in case different periods of accounting is being used for consolidation purposes, in that case, any major event happened during that period should be adjusted in the consolidated financial statement if it is an adjusting post-balance sheet event. Let us take this particular case. A fire which has occurred according to our standard Ind AS, it is not an adjusting event, right? Events occurring after the reporting period, it is not considered, Ind AS 10, it is not considered as a adjusting event in respect of Y, because it has happened on 30th January, whereas 31st December is a year end for Y to prepare. In Y's financial statement, it is not considered as a adjusting event. It will only make a disclosure depending upon whether it's a material or not. When it comes to consolidated financial statement, what happens is that the year end is 31st January. The event has happened on 30th January. Accordingly, this is an adjusting event in the consolidated financial statement. That's the way in which you have to look at and then consider. Similarly, there was some big promotional event which has happened. Again, during the period of my accounting period, I have to consider that. For the other period, it may be non-adjusting event. So different accounting period when it happens, we have to adjust for the other scenarios as well. Another question which is coming in. Okay. So the questions will be taken at the last 15 minutes. Okay. They will be read out to you by Maitreyi. So I will take it accordingly. Then comes to our next line by line consolidation. When we were talking about this adding like items of assets, liabilities, income, expenses, of course, OCI, subsidiaries in full, and how you will account for the goodwill as a sub-process. When I'm saying in the sub-process 3, where investment and the equity portion is being eliminated, if the fair value of the net investment is higher than the equity, there could be a gain on bargain purchase. Whereas if it is lower, then to that extent, there could be a goodwill. So that will be accounted in the consolidated financial statement. When it comes to gain on bargain purchase, IFRS says it should be considered as income in the period in which that has happened. Whereas in respect of Ind AS, we have taken the same call. It will be routed through OCI and added to our capital reserves and will not be taken as an income in the period, even though we call it as a gain on bargain purchase. This is on that step. Goodwill is nothing but what we have talked about. Consideration paid plus what is the non-controlling interest minus fair value of net asset. I will see whether what is the goodwill which I paid. I have paid consideration more than what is the net assets, what is the, in that case, goodwill arises, whether I wanted to recognize full goodwill or partial goodwill. There are two methods which is allowed, but normally companies are using full goodwill method only, not partial goodwill method. But still for academic reasons, I will say how that is being determined. Suppose if you are valuing the non-controlling interest as a sub-process for your step 4, at fair value, if somebody is ready to buy the 20% which is held by non-controlling interest, what is the market value of that 20%? That is the fair value of non-controlling interest. If you are using that as the basis for showing the non-controlling interest in your balance sheet, the entire goodwill will be shown as part of your asset side. And only it will balance. That's the reason why we will do that. On the alternative side, if we are recognizing only the proportionate share of assets and liabilities of the as part of non-controlling interest. So total assets minus total liabilities, what is the net portion? On that 20%, if I'm considering, goodwill will also be partially considered because the NCI will only increase to that extent. I just had one small example how it works out, nothing but the same method in which I have mentioned. So it is self-explanatory. This slides I will share with the ASB. ASB will be hosting, I think, in their website, which can be downloaded by all of you. Transaction within the group, we know what is what, and we have also talked about when we were eliminating whether unrealized profits are also coming in, and Ind AS 12 income taxes comes into the picture. Suppose if the control is lost, what we are supposed to look at is we have to stop consolidation and we have to see the fair value of any consideration received, which has to be recognized. And when we were looking at that, in case if it fully disposed of, then profit on sale of investment will be accounted for. If I'm saying that no, it is not profit on sale, it is only a case of, say, partial disposal, my investment may be reduced from control to subsidiary associate in relationship, then I will account it on equity method. All those things will apply automatically. Finally, the presentation and disclosures are arising out of this, so nothing major on this. I made a quick summary with some small case studies, whatever I have discussed, whatever you might be having in your mind for discussion. This is also, you can use it as a tool for you when you are having any specific questions on doing this consolidation process. Suppose when you have obtained control during the year, not for the full year you have hold, how your profit and loss account has to be accounted for. You have to only recognize post-acquisition profits in your consolidated financial statement. Pre-acquisition profit is automatically part of the net assets, fair value of net assets taken over. So to that extent, it will not be in the profit and loss accounts. That's what I have given. Similarly, when you have lost your control post similar proportionate, you will recognize that. That is also I have given. Coming to joint control, it's a very simple process. As I have explained already in the course of the direction, that we were talking about the various type, joint operation or joint venture. Joint operation means an asset or obligation for the liabilities are done and they are being shared by operators, joint operators. They recognize their respective contribution to that. Joint venture is an independent entity and the right of net assets and including the changes in the fair value of the assets will also come to the investors by means of joint venture agreement. Joint venture is consolidated, not joint operation. Joint operation is only for the standalone financial statement, joint venture for the consolidation. I will take accounting. There are two methods which was allowed as per your AS 27. Equity method and proportionate consolidation method. Now proportionate consolidation method is not available for Indian accounting standard. You have to go with the equity method. So for applying Ind AS 111, you must also understand what is equity method as per Ind AS 28. Then apply the same principles like you do it for your associate investment. So I'm just taking a simple numerical example. It is like accounting for a partnership. If I have made an investment in a partnership, my initial investment I will show as my or capital contribution I have made as my investment. When the partnership is making profits, it will actually make me to have the share of my profits. So that share of profit will be added to my initial investment. If I have drawn money from the partnership, that will be reducing my investment. So that is considered as the net investment in partnership. Same logic is equity investment. Net investment will be shown as 120 to 500. But when this accounting will come is at the time of acquisition. Say, for example, on July 1st, when I have made an initial investment, investment in joint venture will be accounted in the standalone financial statement with a reduction in the bank balance. That's the first entry which comes in. To recognize the share of profits at the year end, let us assume that 31st March is the year end. Then my share of profits is 30,000. So investment in joint venture goes up because I have not taken the money in full, and share of profits is accounted in the consolidated financial statement to that extent of 30,000. When I have received dividends, that reduces my investment. So my bank account is actually, in this case, I have assumed that the previous year's dividend has been declared in September 2024. So I get the money. So 7,500, my bank balance goes up, my investment comes down. That is what exactly I have shown on the right hand side. Initial investment of 1 lakh plus my share of profits minus the contribution I have received. At the end of the period, my investment under equity method will be 1,22,500. Only question is whether I have to eliminate intercompany transactions, intercompany balances, and unrealized profit, like line by line consolidation. Here, intercompany balances are not eliminated. Intercompany transactions will get eliminated only to that extent it is relating to the other shareholders, other investors. Similarly, unrealized profit will also get eliminated only to that extent. That is exactly what is the difference between these two. So again, we were having a step-by-step process of 9 items, but simple method is what I have mentioned in that simple numbers. Same thing which I have explained as a step-by-step process, which we were talking about in this particular example. Interestingly, if the joint venture is making losses, we have to recognize the losses only to the extent of my investment. The reason is very simple, because my investment is limited to the extent of my share capital. I need not take the further hit in my P&L account. I will restrict to only to the extent of my capital contribution or my investment. When they started making profit, whatever I have not recognized, first it has to be get absorbed. Then only I will start recognizing the profit. Very simple concept again in the process. So that brings me to the end of the session, and we can actually take some questions also for understanding this. I will stop sharing the screen to enable Maitreyi and the others to moderate the session further for question and answers.
Dr. Chinsami, that was thank you. That was very thorough and very comprehensive understanding of India's 110 and 111. Amazing depth of clarity that you provided. Thanks a lot for that. We have some questions from our participants, Dr. Chinsami, and I will address them to you now. Yeah. So one of our participants, Mohit Agarwal, is asking that a company has entered into a technical JV arrangement with another company, which is functioning in the name of, XYZ JV. And it's an association of persons, the JV is an association of persons with an independent PAN relating to the project pursuant to a tender document. And the agreed share in this joint venture, 65% belongs to company A, 35% belongs to company B. So will this be considered as joint control entity and equity method of consolidation is to be used? What is to be done in this case is the question.
Okay. The simple difference between a control and joint control is it is based on a joint venture agreement. In this case also, you are mentioning that there is a association of persons which has been entered into, and in the association of persons, 65% is held by one entity and 35% is held by another entity. There is a joint venture agreement that LLP is independently operating. That's a question which we have to deal with. If the association of person is independently generating cash flows without the assistance of A or B, in that case, that will be considered as a joint venture in which A and B has invested. On the other hand, if it is not independently generating cash flows, for every amount of expenditure, it requires additional contribution in the ratio of 65% and 35% has to be made by A and B. For acquiring any asset, again, that contribution is required. When there is any profits which is made, distribution is made in the same way of 65% and 35%. So in those cases, we call that as a jointly operated, a joint operation is the exact word which is being there. It is joint operation. When we are saying joint operation, the classical example which I can talk about is the profit sharing arrangement or PSC contracts which has been entered into between two oil exploration entities. So in those cases, one of the investor will be operating the entire entity and gives an account statement and collect the money. So we have to only look at independent cash flows are generated, or it depends on the investors, based on which, if it is dependent on investor, joint operation, no consolidation. If it is independently generating cash flow, then it becomes a joint venture. Then automatically the operation comes in, the consolidation comes in.
There seems to be a lot of confusion on this point. There's one more question relating to this. So two parties set up a separate vehicle, an SPV, and the vehicle owns assets, but all the output is taken by the parties. So this is almost like a production sharing contract, PSC.
Okay.
All the output is taken by parties and they guarantee its liabilities. In practice, would this arrangement be classified as a joint operation or a joint venture?
Okay. This is the problem. The confusion is created because of Ind AS 111. If you see AS 27, AS 27 and come to Ind AS 111, you will have a better clarity. In fact, my career started when Raghu was mentioning 2-3 decades of discussion on financial reporting. I started with accounting standard. If you see AS 27 classifies the entire investment into 3 categories. One, jointly controlled operations, jointly owned assets, and jointly controlled entities. So if we see jointly controlled operations or jointly owned asset, we call that as a joint operation under Ind AS 111. Very simple. In that case, what you will be doing is what you have contributed. So for example, if in this example, they are talking about asset. So what I have contributed towards the purchase of the asset, in my books under property, plant and equipment, I will show that as an asset in the relevant category. And of course, I will also explain that this is jointly held with so-and-so with the right. We have only accounted for the portion which we have contributed. Similarly, when we are saying we have I think in the example, they have also invested in the asset, whatever benefits arising out of that production facility, the profits is not shared, the entire outputs is being shared. So in that case also, it's a jointly held operation. So it is again, our AS 27 is saying that it is equivalent to Ind AS 111 joint operation only. So no individual consolidation. Whatever expenses I have incurred, I will account it as an expenditure. Whatever income which I am getting, I will show as my income. So the third one is when a separate entity formed, that separate entity generates its independent cash flows and it only declares a dividend or something like that to me, then joint venture comes in. So my request is go to AS 27, then all your confusion under Ind AS 111 will get resolved.
Thank you. That was, nice journey from AS 2728 to where we are now. So thanks for sharing all that, Dr. Chinsami. The next question is from our participant Balaji Vaidyanathan, who's asking, what's the requirement in case of consolidation of an investment company?
Okay, there is investment company. Let's take an example that I'm just making an investment in another entity. And naturally, the moment I say invest in another company, I'm only an investment company. You will know my intention is not to run that particular company, and accordingly, I don't claim any stake on that company. So maybe I will have my nominee directors on the board to protect my interest. Protective rights is what we call that. And India's 110 specifically gives an exemption which companies are away from the consolidation process, where the investment companies can actually apply consolidation exemption from the perspective of their style of operation. That is what Mr. Balaji may be looking for.
Yes, thank you. There's another question from Girish Kumar Amrital Solanki, who says that suppose A Limited is holding 48% stake in B and 40% stake in C Limited. C Limited in turn is holding 30% stake in B Limited. Whether consolidation requirement will be applicable to A.
Okay.
A is holding 48 in B and 40 in C. C is holding 30 in B.
Okay. Cross holding. So we are actually talking about two fellow subsidiaries. There is a cross holding is there in that company. When we were looking at that, it's a simpler arithmetical calculation. We have to look at whether control is being exercised or not being exercised. You remember that we have also mentioned that shareholding pattern alone or voting rights alone is not the factor to decide consolidation. So if there is a cross-holding happens, normally what happens is both the entities will vote the resolution in the same manner. It normally happens in the group level companies. Bigger conglomerate will be having so many companies, cross-holdings will be there in those cases. In that particular scenario, we normally look at the ultimate parent company's level, how my investment in B and C is being done. And in that process, if the cross-holding gives me an edge on B Limited, that's more than 50% or 51%, I normally consider that. Even without that, the voting rights of the other shareholders in B Limited also to be considered by C Limited. C Limited should also consider the voting rights of B Limited, the other shareholders' voting rights. And both will determine how A Limited will determine or consolidate, whether B will be consolidated subsidiary through direct holding as well as indirect holding. C Limited will be whether it will be consolidated with the A Limited through direct and indirect holding. So we have to actually do an arithmetical calculation as well as apply the condition on if voting rights is not giving me the majority of the share voting rights, what is the rights of the other shareholders? That should also be looked into. I think that will give the clarity. And majority of the cases, my practical the experience is that all these will be considered as fellow subsidiaries and A will be consolidated. This normally will happen.
Thank you, Dr. Chinsami. Our next question is from Mohit Agarwal, who says the unrealized profits and losses during consolidation are to be eliminated only to the extent of the shareholding percentage of the holding company, or do they have to be eliminated 100%?
Okay. Again, the method differs between whether it's an upstream transaction or downstream transaction. So when I am saying that a parent company sells to subsidiary company and subsidiary company sells to parent company, so the downstream transaction 100% elimination will happen because parent company profits is actually sitting in the subsidiary company. Whereas subsidiary company sells to parent company, upstream transaction, what happens is if 100% won't, there is no question of I'm worried about this. Suppose if other shareholders are there, 100% elimination is not correct because that is not my share of profits. Another person is holding, say, 40%. That is relating to them. Only that portion alone will be eliminated. That's what exactly happens. We have to see whether it's upstream or downstream transaction and then accordingly do. This is the same method in which India's 111 will do. Because in India's 111, there is 2 joint venture partners. So it will be normally considered as a upstream transaction and proportionate elimination of the profits alone will happen.
Thank you for that. We have one very interesting question. A foreign subsidiary follows local GAAP for inventory valuation, while the parent follows Ind AS. So, what
Okay.
practical adjustments are required during consolidation, and how do groups typically operationalize this?
So Indian company is the parent company and foreign is a subsidiary or what?
Foreign is the subsidiary, and foreign follows local GAAP, while the
Okay.
parent
Okay.
follows Ind
Okay.
AS.
Okay. So one important thing is for the purposes of consolidation, the basic first step itself, we have said the consolidated financial statement should be prepared as per uniform accounting policies. Let us assume that the parent in India is preparing under Ind AS, so naturally under Ind AS 110, and the subsidiary in foreign country, let me assume that they are preparing under IFRS, straight IFRS. So the differences will be very minimal. Mr. Raghu was also mentioning that point. We have almost removed all the carve-outs, and accordingly, what we have accounted as an accounting policy in under Ind AS will be same under IFRS also. Most likely, line by line addition will be straight away happening. If it is not under IFRS, then what happens is we have to convert that into Ind AS is option one, or we can find out what are all the account balances where the accounting policies are differing between, let us assume US GAAP versus Indian accounting standard. Foreign subsidiary is in the US. Then US GAAP accounting policies for a particular item compared to what is the accounting policy under Indian situation, we have to quantify the impact, adjust that impact alone as a consolidation adjustment. You can simply add the number of parent company in one column, then subsidiary company another column, consolidation adjustment as the third column, and the intercompany elimination as the fourth column. Finally, you will have the consolidated number. Both the options are possible. You can think about preparing fresh for consolidation purposes, or you can do the adjustment only for the accounting policy differences. Both the options are possible. IFRS, I believe that 99% there will not be any difference, but still you have to look at whether any other peculiar items are there.
Thank you so much, Dr. Chinsami, and we've come to almost the end of our session today. It was absolute pleasure having you and hearing from you on Ind AS 110 and 111. Your in-depth insights and all the examples that you gave, the practical insights that you gave, and all your experience just shone through what you shared with all of us. So deeply obliged to you for sharing your knowledge so freely and so deeply. Thank you so much for that. And I would also like to express my, gratitude to the Accounting Standard Board under the leadership of Sanjeev Kumar Singhal and CA Vishal Doshi for organizing such insightful sessions. Also to CA K. Raghu, our past president, who came here and shared rich insights on, practical what knowledge of the accounting standards can do for us and what opportunities are available in the market for us. So many thanks to him for that, and to the ASB Directorate as well. I know Rahul is here on camera with us, and of course we have Shalini and the others in the background. So many thanks to them and to the technical support group for organizing this, to the participants for identifying such lovely questions to ask us, and to get insights from our expert, Dr. Chinsami, who's here with us. So thank you for asking those questions, and I trust this session would be deeply relevant to everyone who is here. So thanks, everyone. And with that, I will hand over back to the Accounting Standards Board and Rahul for wrapping up this session. Thank you very much.
My sincere thanks also to the ASB and all the team members of ASB and technical support team, and especially for you, Maitreyi, for moderating the session in a very fluid manner. Thank you for and the participants for their lovely interaction.
Thank you so much, ma'am, and thank you so much, sir. I would like to place on record my sincere gratitude to our esteemed keynote speaker, CA K. Raghuji, for his words of wisdom. I would also like to thank our esteemed speaker, CA Chinnaswamy Ganesanji, for sharing valuable insights and for addressing the topic with so much depth and clarity. I also thank CA Maitri, ma'am, the moderator for the session, for moderating the session so well. I also extend my heartfelt thanks to the chairman and vice chairman of the Accounting Standards Board in absentia for their guidance and leadership in conceptualizing and launching the Leverage Leadership Legacy webinar series, enabling meaningful knowledge sharing for the benefit of our members and stakeholders. Last but certainly not the least, I sincerely thank all the participants for their active participation and engagement throughout the session. Your involvement is what gives purpose and relevance to these initiatives. Once again, thanks all to all of you continue for your continued support and for being part of ASB's ongoing efforts to promote learning and thought leadership in the field of financial reporting. Happy Lori to all of you.
Thank you.
Yeah. Thank you.